Welcome back, Vittorio here, and now it's time to talk about taxes. So we are going to have an introduction to taxes so that you have a clear idea on how they work when it comes to investing. So we're not going to talk about taxes regarding your job, business, or stuff like that. We focus on what regards investing. And a couple of disclaimer, the content is for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice. And you should take independent financial advice from a professional you're in connection with, or independently research and verify any information that you find on our group and wish to rely upon, whether for the purpose of making an investment decision or otherwise. Why am I making this disclaimer? Because I'm not a tax advisor. I'm here to give you an idea on how taxation works for the purpose of making you confident when it comes to investing on your own. But when it comes to very nuanced questions or stuff like this, we can help up to a certain extent, but to have a precise answer, you need to have the support of a tax advisor that is specialized in these things. Cool? So let's now talk about the three types of taxes that you will face when it comes to investing. Number one is the most common one, capital gain, which is the profit earned on the sale of an asset which has increased in value over the holding period. You buy something at 100, you sell it at 120, you pay taxes on the 20 that was the gain that you made. And so how does it work here? Realized capital gains are taxed, which means that if you buy something at 100, now it's worth it 120, but you don't sell, you never pay taxes so far, at least for taxation how it works now. It goes to 150 the year after, you still didn't sell, you don't pay taxes. It goes to 140 and now you sell, well, you pay taxes on the 40. Doesn't matter that it was 120 or 150 before. In some countries, the holding period determines the percentage, like the US, while in other countries, it is a fixed percentage, like most of the countries in Europe. This is the first one and the most common one, and also the most annoying one because it's the one that you pay most often. Then you have the dividends ones, which is a distribution of profits by a corporation to its shareholders. In simple terms, I'm owning the share of Apple. To reward me, Apple say, hey, this year we made 100 billion in profit and probably too high. We made 10 millions in profit and we are going to use 5 of these to reinvest in our growth, and 5 of these we will distribute it as reward to our investors. And this will be paid to you based on the shares that you own. In this case, companies pay dividends out of after-tax profits, which means that the taxman has already taken a cut. Shareholders still pay an additional tax rate. Complicated things to say. The company itself pays a tax on the dividends, but you don't care about it. You pay a tax rate on the dividends. Why I'm not giving in percentages? Because taxation in each country can vary. You should do your own research based on your location. We are also going to focus on your specific country later. And finally, the least common one, which is likely even that you don't find, interest. Interest is earned on top of the original investments, which are the deposits placed into the account. This is what happens when you buy a bond, which means a contract that says, for example, to the government, it's a government bond, and it says, I'm going to give you £100 government, you give me this contract that says that I'm going to get 5% every year on the £100, and then I get my £100 back. That's a bond. In that case, the interest earned from an asset is taxed and calculated based on the return you would get if you held it until maturity, starting from when it was first issued. In simple terms, you pay the taxes on the gain that you make. So yes, it's not technically a capital gain because it's not appreciation, but in most cases, it behaves literally as a capital gain tax. You pay taxes on when you make money. Anything that you do, they're going to make you pay taxes. That's a simple thing. Cool? And so we also want to clarify what it means gains realized and unrealized. As we said before, taxation applies only when you sell something. So if you keep something, whether it's at a gain, which means that it's at a higher level compared to when you bought it, or at a loss, which means that it's at a lower level, in both cases, if you don't sell, these are called unrealized. An unrealized gain, it's an increase in the value of an asset that an investor holds but has not yet sold for cash, such as an open stock position. You buy a share at £100, it's worth 120, you didn't sell, it's an unrealized gain. An unrealized loss, same thing, in the opposite case. Decrease in the value of an asset of investment that an investor still holds. You bought a stock at 100, now it's worth £80, you didn't sell, it's still unrealized loss. And a gain or a loss becomes realized when the investment is actually sold. Quite simple, right? So capital gains are taxed only when they are realized, and capital losses can be used to deduct the amount of taxes that you pay. Because obviously, in one end, you're making money, the government says, give me my chunk. In the other case, you're losing money, and so you can use it to offset the other taxes. How? Like this. How much actually will you pay in taxes in a typical year? If you make money from selling an investment, which is a capital gain, but you also lose money on another investment, which is a capital loss, because you're losing your capital, you can use your losses to reduce the taxes you owe on your gains. You can either do this in the same year or even use losses from previous years, usually up to 3 past years, but depends on your country, to help lower your tax bill. And so, let's say that you bought 2 investments, both at £100, A and B. 1 year goes by. One is worth 150 and the other is 70. Up to this point, you didn't do anything. So what are these? One, it's an unrealized gain. The other, that is a 70, is an unrealized loss. Then you sell this position. And in one end, you get a capital gain, or actually you pay a capital gain on £50. On the other end, you have the capital loss of minus 30. So where the amount of taxes that you pay will actually be on the £20, which is the net between 50 and 30. Should simple enough. And so let's quickly summarize the definitions of the key concepts for taxation, which apply wherever you are based. Capital gain, the profit earned through the sale of an asset which has increased in value over the holding period. Unrealized gain / loss, decrease in the value of an asset or investment that an investor holds but has not yet sold for cash, such as an open stock position. Realized gain, a gain, opposite case or a loss, becomes realized when the investment is actually sold. And taxes are generally applied only on realized gains. Why am I saying generally? First of all, because taxation can change. Number two, because in certain countries you also pay taxes on the overall amount of investments that you have. In Italy, for example, you pay 0.2% of your total assets invested every single year. Terrible idea in my opinion, but that's what it is. Tax advantage account, which is what we're going to talk about after this, is a kind of saving plans or financial accounts providing you with a tax benefit such as tax deferral or tax exemption. What does it mean? It's a way to invest so that you get some benefits on the way in which you would normally pay taxes, either by postponing these taxes later when you're older or to just not pay taxes. That's the cheat code of the game. We want to use as many tax advantage accounts as possible that can help us optimize our taxation. But to do that, we had to understand all these concepts. And so I hope this was a very helpful lesson. Definitely is very important. I'll see you next time. Be stoic.